Welcome back. Our pal Blake Christian is here this morning from HCVT. I've learned just a little bit about this powerful firm. We're sharing a little bit of background, of commonality, and this morning we are going to talk about opportunity zones and educate you a little bit both on the investment value and on the tax planning value of this new perspective on investing. Good morning, sir. How are you?
Good morning, Terry.
Great to see you. I love that jacket. I have to say it. You got to rep when you got somebody who's got the style in the studio. We appreciate it.
For a CPA, you know.
Hey. Well, with a jacket on like that, I can say you got to be much more than just a CPA. So,
thank you.
Good to have you here. Talk a little bit about opportunity zones for people who may not be familiar with the concept, with the category. Give us a little background, please.
Right, so it's a brand new program under the Federal 2017 Tax Act. Again, it's a federal program. Some states have adopted. Utah is one of them that so far has adopted it, but they could opt out, but I think they'll stay in. California has affirmatively said no, we don't want to opt in, so it makes it a little more complicated on the planning. But in a nutshell, what it allows you to do is basically sell any capital asset. You could sell a business, you could liquidate your portfolio, you could sell a collector car, you could sell Bitcoin. And short-term or long-term capital gains can then be invested in a qualified opportunity zone fund. And by doing that, you can defer the tax until 2026. So up to 8 years. On top of that, at the 5-year and 7-year mark, you get to permanently eliminate 10% at the 5-year mark and another 5% at the 7-year mark. Those are kind of little, benefits, but the real juice out of the program is after 10 years of holding it, and let's say you defer $1 million, okay? So when you get to the 10-year mark, and let's say that investment is now worth $1.5 million, that extra $500,000 appreciation goes poof. You never pay federal tax on it, and if you're in the right state, you don't pay state tax on it. So it really increases your after-tax return on investment.
And this is very much focused on the encouragement of long-term investment and holding. You made the comment just as we were sitting down and beginning our conversation that when you first looked at this, you weren't convinced, I think it's fair to say, right. And yet I guess as you've gotten deeper into an understanding of the details of the act, that you've warmed to it. Talk about that thing of long-term investment versus investment flexibility and fluidity, and how you come in on comparing those.
Right, and I was very cold on the idea at first. It was just too complicated, too costly, and the timeline was too long. But again, when you start running numbers on this, and it works really well for real estate, but you could also start a business in one of these opportunity zones, and it's really important to understand that it's very specific investments you have to make out of that qualified opportunity zone fund. You have to invest in one of 8,700 census tracts across the country that have economic challenges. So they have, the residents there have lower than average income, and there's other challenges to living there. And there's about 18 census tracts in Utah, many of them in the Salt Lake area that are, very good areas to start a business. So everybody talks about making real estate investments, but you could start an IT company or, almost any type of company. There's a few exclusions, what we call kind of sin businesses, so to speak. So you can't have a liquor store, which you wouldn't have here anyway.
Right.
You can't have a massage parlor. You can't have a golf course.
Oh, interesting.
Which isn't a sin, but
I was going to say that. I was fine with the list until the final one.
Right.
But So it's fair to say that this is as much from a government standpoint, this is as much about encouraging investment in these zones that are actual physical geographical places to encourage the flow of capital in a way that helps turn around, or at the very least gentrification or improvement in these areas, while also obviously offering the investment benefits.
Exactly.
More?
No.
Are you recommending this? I guess I would say, when you use a number like $1 million, obviously we're talking about qualified high net worth investors. But within your client base and the people that you advise, is there a set of characteristics as an investor? Of course, I'm thinking of kind of the social investor who says, I want a good return, but I want to do well by doing good.
Right.
Is there a recommendation kind of criteria that you have?
So, the calls that I'm getting range from, a guy selling a business that's going to have $100 million gain, and he wants to diversify, and somebody coming out of an active business often is attracted to real estate. And so probably about 80% of the calls that I get are people wanting to invest in their own backyard. And so they already know the lay of the land there. They know that even though it may be a little bit of a depressed area, that it's coming back. And so that insider information on a real estate investment is very handy on something like this. I have had some, what I would call social, economic investing type clients and calls where they, one wants to do a wind farm, and even though they're not going to make, they know they're not going to make a whole lot of money on it, they still feel that it would attract other investors, and they could still get this project done that they have a passion for, and they feel that it's a very green project. They focus on that, and so it kind of helps the underpinnings of their strategy.
And knowing your clients is always an essential part of that, to know what types of recommendations and who will jive well with a particular type of initiative.
Right, and you touched on it being kind of geared towards more high net worth individuals, and Sean Parker, who was one of the early Facebook investors and things, he was one of them that came up with the concept, because he had all these $100 million, billion-dollar friends that were sitting on these huge gains, and but they didn't want to trigger them and diversify because of the huge tax burden. And so he said, hey, we can do good while also making it a little more tax attractive to investors. But I do tell people, you'd really, you wouldn't want to set up, and you can set up a fund just for yourself. You don't have to have it widely held. But I generally tell people, unless it's probably $500,000, it's not something that you'd want to set up your own fund for, just because you have to set up a couple of entities. You're going to have that annual cost. Yes.
Yeah, all of that. Where should folks get a hold of you to have more conversation about this topic? And I'm sure that there are many others that I hope that we'll have a chance to discuss here as well.
Right. Well, our office number here is 435-200-9262. Our website is hcvt.com, and there's in the tax articles and tax alerts section, there's a lot of information on the program. So
fantastic. A pleasure to meet you. Glad to know that we have this kind of expertise right here in town, and we don't have to go all the way to Southern California for it. And I'm sure that we'll see one another again very soon.
Great. Thank you very much, Terry.
Pleasure.
Appreciate it.
All right, you guys, we're not out of here just yet. We're going to take a quick break. We'll be back to close the show. Please stay tuned. We'll be right back.